So, once you've identified a company that appears strong, defensible, and well positioned for long term growth, the next step is to dig a little deeper. This means diving into the numbers to figure out how a company actually operates and where it's likely headed next. This is what we'll cover in this third module. First, we're going to talk about the big three financial statements, what they can tell you, and why they're important. Then we're going to talk about some of the key types of financial ratios that investors use to analyze a company's operations. And then we'll talk about some potential pitfalls to avoid. For long-term investors, the foundation for analyzing whether a company is a good investment or not lies in that company's financial statements. Financial statements are a standardized set of reports that publicly traded companies are required to publish regularly. In the United States, that's every quarter. The three primary reports are the income statement, the cash flow statement, and the balance sheet. These reports provide you a snapshot of a business's operation and give you all the raw data needed to assess an investment's potential. First is the income statement, also sometimes called a profit and loss statement, or P&L. It reveals a company's revenues, expenses, and profits over the course of a quarter or a year. It can provide a key look into things about a business like profitability and operational efficiency. And it's where you'll find key metrics like revenue growth, gross margins, and net income. And as you can see here, for each of these financial statements, GuruFocus provides a chart that breaks down the report, so you can quickly and easily visualize how money flows in and out of a company. Similar to the income statement, the cash flow statement tracks a period of time. However, unlike the income statement, which includes non-cash items like depreciation, the cash flow statement is all about how a company generates and uses cash. This report helps investors assess something called liquidity, which is basically just a fancy way of saying whether or not a company has enough cash on hand to meet all of their obligations. It's also where you'd find metrics like operating cash flow and free cash flow. And finally, the balance sheet. Unlike the cash flow and income statements, which cover a period of time, the balance sheet only records a single snapshot in time. And it primarily answers the question of what a company owns versus what it owes. It can help you determine the financial strength of a company. It's where you find key metrics like total assets, total liabilities, and shareholders' equity.